And now, back to the Bablu story. The Bablu credit scheme was very well received by our customers. Word got around, and as a result, more customers came to Bablu Biryani. They would come to the restaurant, have as much biryani as they liked without ever having to worry about the payment. Bablu Biryani grew like anything. Sales doubled, then tripled, and more customers were still coming. The credit scheme was working. No, it was flourishing. The bank kept giving me more money against a security of my current food inventory and my receivables. At this point, I became an entrepreneur in every sense of the word. I started negotiating with my suppliers to provide raw material on credit. The suppliers, looking at the growth of Bablu Biryani, had no hesitation. They gave me credit and in turn showed the receivables from me to their own bankers. Their banks gave them credit too. In just a matter of 3 months, Bablu Biryani transformed from a small outlet to a grand restaurant. Bablu Food Center. The new restaurant had more branches, offered more dishes at a high price, offered free delivery, and even had a customer loyalty scheme. Everything on credit. Sales volume increased massively. Banks and suppliers lent more. Money was flowing in.
Life couldn't have been better than this.
In a span of about 6 months, my innovative banker friend came up with another idea. He advised his bank management to securitize the loan and float it in the market. The bankers came up with innovative products and started selling them to investors. Nobody was bothered what was the underlying asset for these bonds and why should they be. The bonds were offered by one of the largest banks in the world, so they were being sold at the face value of the bank. The rating agencies also rated the bond as AAA. In this way, the price of the bonds also kept increasing. People were making good bucks and the bonds started trading internationally.
अरे नहीं रख लें इसको 6 महीने के बाद दीजिएगा आराम से मैं लिख लेता हूँ रख लें
On the other side of the story, investment bankers in the USA also came in and thought of making more money out of these mortgage loans. And why shouldn't they? After all, they are also humans with an urge for making more and more money. Their idea was securitization, which simply means taking a bunch of assets, pooling them together and offering them as security to someone else for another loan. Creativity at its best.
Financial sector itself became deregulated and became in some ways a producer in its own right. And we are all familiar with this what I would call the yuppie terminology of financial products.
Now the investment bankers come in. The commercial banking part is over, the investment banking part starts here.
At the same time, the banks were not keeping these subprime mortgages on their own balance sheets. They were making this into a securitized asset.
Future contracts,
asset-backed securities,
options,
asset-backed commercial paper,
interest rate swaps,
collateralized debt obligations,
credit default swaps,
which means that they aggregate all of them, make a security and sell it to the other private equity funds, to the investment banks, to insurance companies.
There was a castle of the cards.